In the last few sessions, we've looked at the functioning of equity stock markets, where the equity shares of firms listed in the stock exchange are quoted publicly. Hence, equity stock markets are also known by the name public equity markets. On the other hand, a private equity market is one where the equity shares of firms are not quoted publicly on the stock exchanges. Instead, they are held privately by large institutional and high net worth investors with a long-term investment horizon. In this session, we will look at why private equity markets have emerged. Remember, they are very recent in origin, roughly 30 years old. We will also look at the scope and structure of the private equity market. Private equity has come to be an important source of funds for startup firms, private mid-market companies, firms in financial distress, and public firms seeking buyout financing. Therefore, private equity would include venture capital, i.e. financing of early stage companies, most often engaged in innovative technology related products, financing mid-market companies which are stable, profitable businesses in the manufacturing and distribution businesses who require funding for expansion and or change in their capital structure and or change in their ownership structure. Capital invested privately in public companies, either as debt or as equity, to help them through financial distress or to avoid public disclosure associated with IPOs and FPOs. Now, why do firms go the private equity route? Firms that source funds through private equity tend to be those that will generally not be able to raise funds in other markets such as the bond market, the public equity market, or even a bank loan. Hence, private equity has emerged as an important intermediary in financial markets, especially appropriate for firms where large information asymmetries and agency problems exist. For the same reason, private equity would also be one of the most expensive forms of financing. However, by the very nature of the private equity market, the adverse selection and the consequent moral hazard problems are addressed by private equity. Public firms resort to private equity sometimes to finance activities such as planned acquisitions which they want to keep confidential, or acquisitions involving complex business strategies that public retail investors would not be comfortable with and would rather prefer that it be analyzed by large private investors. A common theme in many recent going private discussions is the compliance costs of being a public company, which is related partially to the adoption of recent legislation such as the Sarbanes-Oxley Act in the United States. For this reason, several large companies, particularly in the United States, have gone private in recent years or are considering going private in the near future. Now let's look at the private equity structure. Professional private equity managers are organized as limited partnerships. This structure was fostered by regulatory changes in the 80s in the United States that permitted greater participation in private equity by pension funds, for example, who have great depth in their liability support, and Rule 144A, adopted in 1990 by the Securities and Exchange Commission, by which private securities could be freely traded among select class of institutional investors. Partnerships in the private equity world comprise institutional investors as limited partners and a team of professional private equity investment managers as general partners. Private equity firms raise a series of funds for investing in the equity and sometimes in the debt of firms that are identified by the general partners and the investment directors in that private equity fund. This will be in keeping with the investment strategy articulated in the prospectus of each PE fund floated by the private equity firm. So in conclusion, private equity is here to stay. In fact, it has already dented and could potentially even eclipse the public equity market in due course. Private equity is on a sound footing thanks to the ability to draw on well-tested financial theory and practice from the public equity market. Agency conflicts do arise at two levels in private equity firms: limited partners versus general partners, and general partners versus the portfolio companies, i.e. the companies where the private equity fund has invested in the equities or in the debt. These, interestingly, have been very well understood and reasonably well addressed through contracts, covenants, control of the firm through the board of directors, incentive structures to the general partners, etc. Emergence of advisors in the private equity market to mitigate the agency conflicts that we just saw has brought with it a different set of issues which will need to be studied and addressed going forward. The boundary of private equity needs to be clearly defined and defended, if necessary, through regulation. Else, in the name of financial innovation, private equity markets run the risk of being corrupted by aggressive entities like hedge funds who have a huge risk appetite.